For years, discussions about central bank digital currencies have focused on one word, digital. But money is already digital. When the euro was introduced in 1999, it first existed only as digital balances inside banking systems. Physical banknotes followed later. Today, most money exists digitally, as numbers recorded on bank ledgers. So the real question is not whether money becomes digital. The real question is this: why are central banks exploring a new monetary architecture now? Is it simply the next step in payment technology? Or is it a response to deeper pressures building inside modern, highly indebted financial systems? Central bank digital currencies are not simply about digitizing money. They are about who operates the ledger where money exists, and what rules can be embedded into that infrastructure. If money is already digital, what exactly would it change? To answer that question, we first need to understand how money works today. Most modern monetary systems operate through what economists call a two-tier structure. At the top sits the central bank. Central banks issue currency, physical cash, and the reserves used by commercial banks to settle payments between themselves. Below that sits the commercial banking system. When commercial banks issue loans, they create deposits. Below that sits the commercial banking system. When commercial banks issue loans, they create deposits, and those deposits become the money that circulates throughout the real economy. In our earlier episode, we described this as money being created by lending it into existence. Most of the money people use every day, salaries, payments, and business transactions, exists in this form. When you check your bank balance, you are not holding central bank currency. Instead, you hold a claim on your commercial bank, recorded on that bank's ledger. In other words, the modern financial system runs on many interconnected ledgers maintained by commercial banks. The central bank provides the settlement layer that allows banks to transfer money between each other. What if currency were issued directly on a central bank ledger instead? Central bank digital currencies explore exactly that possibility, instead of money existing primarily on the ledgers of commercial banks. Central bank digital currencies explore exactly that possibility, instead of money existing primarily on the ledgers of commercial banks. Digital currency could be issued and recorded directly on a central bank ledger. Individuals and businesses could hold digital currency that represents a direct claim on the central bank. This is why CBDCs are often described as digital cash issued by the central bank. The difference may sound subtle, but architecturally it is significant. It changes where currency is recorded, who maintains the ledger, and how transactions are ultimately settled. CBDCs are about centralizing the ledger where currency exists. Central banks already influence the money supply in today's system. They do this indirectly by shaping the environment in which commercial banks create credit. Interest rates, reserve requirements, and asset purchases influence how much lending commercial banks extend. But these tools operate at a broad system level. They influence incentives rather than controlling individual units of money. In practice, this means monetary control is relatively loose. Central banks steer the system, but commercial banks still decide how much lending, and therefore how much money creation, actually occurs. A centralized digital ledger could potentially tighten that transmission channel, instead of influencing money creation indirectly. Central banks could issue, adjust, or withdraw digital currency more directly within the monetary infrastructure itself. Exactly how direct depends on design. If central banks could issue digital currency directly, would commercial banks still be necessary? In practice, most CBDC proposals preserve their role. Commercial banks perform a critical function in modern economies: credit creation. They provide mortgages, business loans, and other forms of credit. Deposits created through lending are also the primary funding source for banks. If deposits moved to CBDC accounts, banks could lose their funding base. Without deposits, banks would have far less capacity to extend credit. This is why designs attempt to preserve the two-tier structure. For this reason, Most CBDC designs attempt to introduce digital central bank currency while preserving the two-tier structure of the financial system. Commercial banks would still manage customer relationships and distribute digital currency. The goal is not to eliminate them, but to adapt around them. One of the most important differences is the possibility of new functionality embedded directly into money itself. If currency exists as software, it can carry rules. Transfers can become conditional. Payments can be automated. This idea is often described as programmable money. Supporters argue this makes systems more efficient. Critics point out that embedding rules also raises questions about governance. If a central institution controls the ledger and the rules embedded in it, the system gains a powerful new policy instrument. Central bank digital currencies are being explored for several reasons. Payment technology has advanced rapidly, private digital money is emerging, and many advanced economies operate with high public debt and increasingly complex financial systems. Like any major change, CBDCs involve trade-offs. Questions arise about privacy, the role of commercial banks, and governance. For these reasons, most central banks are proceeding cautiously. Many CBDC projects remain experimental. But central banks are not the only actors. Another model is emerging from the private sector: stablecoins. They raise an important new question. What happens when private actors begin issuing digital money backed by traditional assets? That's what we'll explore in the next episode. The future of money will not be determined by a single technology. It will evolve gradually through changes in financial infrastructure. Watch the relationship between central banks and payment platforms. Understanding these shifts may reveal where the next stage of the cycle is heading. Central Bank Digital Currencies is part of TNBC Explainers Module 3, Economy, Money, and Financial Power. Explore the TNBC Explainers course via the YouTube course list or visit thenextbigcycle.world for the full course overview and background. This is The Next Big Cycle, TNBC Explainers, your guide to understanding the systems shaping the world around you. TNBC Explainers is a growing YouTube course. New concepts are added over time.